Index funds, mutual funds, hedge funds, ETFs. You've probably heard these terms thrown around before. But what do they actually mean? And what makes them different from each other? In this video, I'm going to walk you through these four types of funds in the clearest, most beginner-friendly way possible. We'll cover what they are, how they work, the risks, the fees, and who they're really designed for. Stick with me for the next 10 minutes and you'll walk away with a level of clarity most people spend years trying to figure out. Just a quick note before we start. The information in this video is not financial advice. This is an educational video, and the purpose of it is to enhance your financial literacy so you can make better and informed choices. Now let's get started. First things first, what is a fund? Before we compare the different types, we need to understand the basic idea of a fund. Think of it like this. Imagine you and a group of friends want to buy something expensive. Let's say a gaming console, a big screen TV, and some snacks for a party. Instead of one person paying for everything, everyone throws in some money. Now you've got a shared pool of cash and you can buy more than any one person could afford on their own. That's basically what a fund is. It's a collection of money from lots of people, managed together and invested in things like stocks, bonds, or real estate. Instead of you making every investment decision by yourself, the fund does the heavy lifting and you get a share of whatever happens, whether that's gains or losses. Index funds. Let's start with index funds, since they're one of the most popular choices out there. The idea behind an index fund is super simple. Instead of trying to guess which company will do well, it just copies a list of companies, called an index, and invests in all of them. Think of an index as a kind of playlist of companies. For example, the S&P 500 is a playlist of 500 of the largest US companies. The NASDAQ is more of a tech-heavy playlist with companies like Apple and Microsoft. The Dow Jones is a smaller list of 30 well-known giants across different industries. Index funds don't try to beat the market, they just match it. This is called passive management, and it's one of the reasons they're so cheap to invest in. Fees are tiny, usually just a few dollars per year for every 1,000 invested. One detail to know: index funds don't trade in real time like individual stocks. They're priced only once a day, after the market closes. So if you buy during the day, your order gets filled at the end-of-day price. Who are they for? Anyone who wants a set-it-and-forget-it investment. They're affordable, low risk compared to picking individual stocks, and a favorite for long-term investing. Mutual funds. At first glance, mutual funds look almost the same as index funds. You pool your money with other investors, and it's spread across many different assets. But the big difference is in the management style. Mutual funds are usually actively managed, which means there's a professional manager, or even a team, constantly deciding what to buy and sell, with the goal of beating the market. Sounds appealing, right? But here's the catch. All that active management comes with higher fees. Instead of paying a tiny fraction like with index funds, mutual fund fees are often 10 to 20 times higher. And even then, studies show that most mutual funds don't consistently outperform the market. That said, some investors still choose them. Maybe they believe in the manager's strategy, or they want exposure to niche areas, like a fund focused only on healthcare companies or emerging markets overseas. Like index funds, trades in mutual funds are also processed once a day after the market closes. Who are they for? Investors who want professional oversight and are willing to pay higher fees for it, even if the results aren't guaranteed. Hedge funds are in a whole different category. They're private investment funds designed for wealthy individuals and big institutions. Unlike index or mutual funds, hedge funds can use very aggressive strategies, borrowing money to invest more, which is called leverage, betting on stocks to fall, known as short selling, and trading complex financial contracts, also known as derivatives. Because of this, hedge funds can generate massive profits, but also massive losses. They're not regulated the same way as mutual funds or ETFs, and they're usually only open to people who qualify as accredited investors, meaning very high income or net worth. And the fees? They're steep. Many hedge funds follow the 2 and 20 model, charging 2% of your money every year, plus 20% of any profits they make. Who are they for? Not everyday investors. Hedge funds are really only for the ultra-wealthy willing to take on high risk for the chance of high reward. ETFs, exchange-traded funds. Finally, we've got ETFs. If index funds and stocks had a baby, it would look like an ETF. Like index funds, ETFs pool money and invest in a basket of assets. But unlike index funds, ETFs trade on the stock exchange just like an individual stock. That means you can buy and sell them throughout the day at whatever the current market price is. ETFs are flexible, come in thousands of varieties, and usually have very low fees, often close to index funds. You can find ETFs that track the S&P 500, specific industries like clean energy, or even commodities like gold. They're also super accessible. You can buy them in most brokerage accounts, often with no trading commissions. Who are they for? Pretty much anyone. ETFs are one of the easiest ways for beginners and experienced investors alike to get diversified, low-cost exposure to the market. Fee example. Why costs matter. Let me give you a quick example of how fees impact your money. Let's say you invest $10,000 for 30 years. If your investments grow at 7% per year and you're paying 1% in fees, your final amount would be about $57,000. But if you instead paid just 0.1% in fees, you'd end up with around $74,000. That's nearly $17,000 more, all because of lower costs. This is why so many experts recommend low-cost index funds and ETFs as the foundation of a beginner's portfolio. How to choose as a beginner. So how do you decide? Here's a simple framework. If you want broad diversification and simplicity at the lowest cost, go with an index fund or index ETF. If you prefer hands-off investing but are okay with slightly higher fees, you can look at actively managed mutual funds. If you want flexibility to trade during the day or you're investing through a brokerage app, ETFs are a great option. Hedge funds? Unless you're a high net worth investor with a lot of risk tolerance, they're not really on the table. For most beginners, a low-cost index ETF or index mutual fund is the best place to start. That way you capture market returns, keep costs low, and let compounding do the heavy lifting over time. So in short, here's what you need to keep in mind. Index funds equals low-cost, passive, long-term investing. Mutual funds equals active management, higher fees, and mixed results. Hedge funds equals high risk, high reward, and only for the wealthy. ETFs equals flexible, trade like stocks, and low cost for most investors. If this video helped make sense of these terms, hit the like button. Subscribe for more beginner-friendly videos that'll help you become financially literate and master the money game. Thanks for watching. I'll see you in the next video.